Okay, I'm doing it again. I'm blowing the whistle. Hey, let's open a page from Payne's Investment Playbook. Barbara sent this question via Facebook that I know a bunch of you want to know about as well. When you sell a stock and then recommend buying it back, aren't there tax consequences if you buy back within 30 days? Well, yes, there are tax consequences. Now, I don't want to give you the tax advice, but I am going to let Tracy weigh in shortly. Instead, though, let's focus on selling in general. When to sell, because I got to tell you something. This is the biggest question any investor faces. After all, when it's all said and done, some people make money and lose money with the same exact stock. How do they do that? Well, here's the thing. Some people sell too early. Sometimes you sell too late. The decision-making process for buying and selling a stock, in my mind, are the same. First, you have to figure out what kind of an investor you are. After you've done that, let's take a look here. After you've done that, then you have your guideline. Are you a trader? You want to buy and hold for 1 to 30 days. Intermediate term, 30 days to 6 months. Long term, 6 months or longer. If that's the case, here's your risk. As a trader, you don't want to risk more than 5%. Intermediate term, 10%. Long term, I think 20% max. Your reward always should be double what your risk is. So if your risk is 5% as a trader, you want to make 10%. Hey, if you're going to risk 2%, make 4%. Intermediate term, 20%. Long term, I think if you're going to hold it 6 months, a year, 2, 3 years, it's not unreasonable to look for at least 50% of your money. Here's the vigilance. How much time are you willing to commit to this? If you're a trader, you better be ready to look at this market at least 4 or 5 times a day. Intermediate term, I think you should watch it at least twice a day. Just a couple of glances at your position, what the market's doing. Long term, just once a day. And finally, your financial commitment. Now, for me, this should represent one person. And if it was one person, 20% of your money go into trades, 60% intermediate term, and then 20% things that you buy and you hold because you believe in them. Now, obviously, the idea is to find a stock you want to find stocks that are undervalued if you're intermediate term or long term. Traders, I got to be honest with you, really, you don't have to care too much about fair value. You're looking for the greater fool theory, the idea that, hey, I'm going to buy this stock and someone's going to buy it at a higher price from me regardless of the fundamentals. As a trader, you're looking more with charts, volume, and momentum. That's what you're worried about. Intermediate term, fundamentals, things like earnings. Is the company taking market share? Are their margins expanding? Long term is a little different. You're looking at fundamentals, but from a different point of view. You're looking more at the products, the pipeline, the potential, more of the big picture dream. Once that starts to come together, then you must get that execution that takes us back to earnings, market share, and margin. So no matter what kind of person you are, what you consider yourself, obviously there are a whole lot of psychological aspects to investing and that trigger actions that aren't not originally intended. You can be all these things and still not hold it together. And by the way, you must take losses. From time to time, you're going to have to keep your greed in check. You have to be realistic. Stick to who you are as an investor. Don't be inconsistent, because inconsistency is when you get those large losses. You can have 10 winners and 1 loser can wipe them all out. Hey, guys, let's talk about this for a moment, because we get this all the time. I know I do. I'm in the stock. When do I sell it? And I don't know. I don't know what kind of investor you are. Here's the real deal. People fret about getting into the stock market, but the fact is it's a whole lot harder managing that position, taking a profit, and especially taking a loss. Matt, you saw my approach up there. A lot of things to think about. What would you add, and do you have any steadfast rules for investing?
Sure, I think that was fantastic, because I use the same 3. I call the middle, intermediate, and active investor, because I still consider them an investor, but maybe just a little more active than the long-term person. The one problem I have is trying to be all 3 at once. Because you could be that long-term investor, but then if you're short-term trading, you sometimes intermingle those, and next thing you know, you're trading the position that was supposed to be a long-term position because they had one bad earnings number. Right. We see that all the time. Right. When you have one bad earnings number, but the longer-term story is still there. So I think you want to keep an eye on that, and I love that you put 20% loss. I mean, if you go below 20%, you know what? If you're done, get out, move on. That never have a big loser. That will ruin your portfolio.
But what do you do with that? Do you then keep like 3 separate accounts? So they don't get, it's like saving for Christmas and saving for vacation.
You can kind of do that, Tracy. You know why I do that, though? To be honest with you, it's been my experience dealing with individual investors since 1985 that I can't get people to hold the long-term stuff if they're not generating money longer. I can't get them like this stock they say they want to buy and hold. I can't get them to really do that unless I'm trying to generate money. And this actually diverts their attention. And as long as they're netting profits here, they'll let this long-term thing work out. And I mean, it's kind of worked out for me. I want to ask you a question, okay?
Yeah.
Because you saw what Barbara was asking. A lot of people ask about that. We talk about often, hey, I talked this week about the stock that we took a loss on, got back in, that Sierra Wireless is up huge. She would have been reluctant to do that.
So Barbara's really smart because it's called the wash sale rule. It's a tax thing that you got to worry about when you sell at a loss. Keep in mind, you can always sell at a gain. Uncle Sam's more than willing to take your money. He'll tax your gains any time, any day of the week. But your losses, a lot of people generate losses, like you're saying, to offset gains so you can wipe out your tax bill. Well, he doesn't want you to do that. So when you sell something at a loss, you have to wait 30 days before and after in order to get back into the position. Because basically, it would just be a paper loss, and then you're back in the position, and that's not fair, at least to Uncle Sam.
That's why we have you on the show. And in addition to being from Jersey, you are one of the best accountants that I know. Thanks a lot, Tracy.